Everybody, welcome to Managerial Accounting. This is capital investments and net present value. This is part one. We're going to be evaluating, or question one, we're going to be evaluating net present value for multiple scenarios. So my disclaimer and copyright notice, the information, opinions in this presentation are those of myself and not my employers or affiliated organizations, including, but not limited to, Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. Presentation is copyright 2008 to 2024 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. I'll sometimes use information from third parties from time to time, but let's go ahead and get a rolling. So this is our first problem we're going to go through and look at for this particular chapter, dealing with present value. So YYZ, favorite airport out of Toronto, and a great song by my favorite band, is considering making one of the following investments. Each investment will cost a total of $80,000 and will generate the following cash flows. Now, what you notice is the cash, the total cash being received over time is the exact same. It's $108,000. But what is different is the way the cash is coming in, right? And when we're dealing with present value, what we're trying to go through and do is to say, okay, for year one, and let's kind of go through and think about this. In year zero, or yo, I'm investing $80,000, right? It's costing me $80,000. But in year one, basically for project one, I'm getting 5,000, right over here. So I'm getting 5,000. In year two, I'm getting 8,000. Year three, I'm getting 25,000. And by year four, I'm getting $70,000. So what you need to go through and do, so I got a total of 108. However, these future dollars are not the same as today's dollars. And why is that? It's because I could go through, like, would you rather have $5,000 today or a year from now? Well, if I had $5,000 today, I could theoretically earn 8% interest on that, which is my rate of return. The value of that money would not be 5,000, but it would be 5,400. So what I need to do is I need to take these future payments and bring them back to today's dollars. And how we're going to do this is through present value. So for year one, what I'm going to go through and do is I'm going to use the present value of a dollar table. And I'm going to do this for all these questions. And this is basically going to be one period, or when it's being paid away from me, at 8%, which is the market rate of interest. In this case, I'm requiring an 8% rate of return on my investment. So when I go to the present value of a dollar, one period at 8% is 0.92593. So the present value of that $5,000 in today's dollars is $4,630. What does that mean, right? So I can now compare this to the 80,000, but why is that? Well, if I were to invest this at an 8% rate of interest, I would earn $370 of interest. If I add that to the principal, it's worth $5,000. That's how we know it works. Let's go to the next one. Present value of a dollar, because it's a single lump sum and the amounts are different. We cannot use the other table. This is being paid 2 years from now. So this is going to be 2 periods at 8%. So if I come over here to the present value of a dollar, 2 periods at 8%, this is going to be 0.85734. So 0.85734. I multiply this by the 8,000, and I'm going to get 6,859. Is that right? Let's see. Well, in year one, I would be earning interest of 549, right? So this is year one. If I reinvested that interest, right, it's now basically worth 7,407. And again, if I reinvest that interest into the principal, the year two interest, and by the end of that year two, it's worth 8,000. Now, on your exam for my class, you're not going to have to do this. But what I'm trying to get you to understand is this amount cannot be compared to the amount of the investment that I'm making today, because this is in today's dollars. I have to bring these back to today's dollars. Let's go to the next one. Present value of $1. And this is going to be 3 periods at 8%. So coming over here, 3 periods at 8% is 0.79383. 0.79383. Sound like I'm calling out a bingo. Okay. Coming over here, 25,000 times 0.79383, or this amount is worth in today's dollars, 19,846. If I go through and kind of use the same methodology and I say, okay, times 0.08, the value of this is now going to be the end of year one, so be worth 21,433. If I reinvest that amount, my year two interest is 1,715. If I reinvest that amount over here, my year three interest, and if I have that by the end of year three, it's worth $25,000. That's all we're doing. Let's do the final one, present value of $1. This is going to be 4 periods at 8%. So coming over here for this final one, we're going to have over here 4 periods at 8% or 0.73503. So this is going to be 0.73503. I know there's ways to do this in Excel, but this is how I do it on my test. So this is what you should get to look forward to for my exams. So here we go. All right. So we take this amount, we invest it for the first year, interest earned 4,116, add that to the principal. Second year, invest that at 8%, which is our market rate of interest. We get 4,445. This is now worth 60,014. I invest that amount in year three. The value of this is now going to be 64,815. I reinvest that at 8%. And this is worth 70,000. So this part over here, in terms of doing this, we do not need to have this. All that work just went away, because really what I'm more concerned with is what is the value of these future dollars today? And I'll just bring that back over here just for a little bit. So this is for project one. And now to determine the net present value, I've brought all of these future dollars back into today's dollars. Very important to do. And I've brought these back into today's dollars. So to get the net present value, right? My net present value is I'm going to add the initial investment, which is always going to show as a negative, plus the present value of those future cash flows. So my net present value is 2,786. So that's the net present value of the future cash flows. The present value would basically refer to bringing these back into the today, but the net present value is subtracting out the cost of the investment. So now let's go through, because we've done this now for project one. This should be a little bit easier to do for the rest of the projects. So for project 2, right, all of these projects have an $80,000 cost, and we are going to be generating the following cash flows. So for project 2, in year 1, we had 10,000. In year 2, we had 30,000. In year 3, we had 40,000. And in year 4 for project 2, we had a total of 28,000. Notice here, when I add up these 4 amounts, it equals to 108. So when I go through over here and using the net present value, I'm essentially adding up all of these amounts over here. Once I have determined the present value of a dollar for these periods, these values are never going to change, and I use them for all the different investments. So coming over here, my net present value is 7,314. Okay. Now let's go through and take a look at project 3. So for project 3, for year 1 had a value of 30,000. For year 2, 40,000. For year 3, 20,000, and year 4 had a value here of 18,000. I add these up to make sure they equal my cash flows of 108. I'm good to go on that front. And so the net present value, I'm adding up the year 0, which will always be negative. So the net present value is 11,179. Okay. So 11,179. Now, the last project is project 4. And this project has the same payment each year. So we can still, though, use this same table, but I'm going to show you a trick which will be exciting. So it's always exciting in managerial accounting. Project 4, this is 27,000 per year for 4 years, or $108,000. Okay. Now, if I go through and add these up, my net present value of these future cash flows is going to be 9,428. So come over here. My present value for project 4 is 9,428. Now, before we go any further, what I want to kind of discuss with you before we get to the analysis is I want us to look at how the payments are being made. Project 4 is unique. Why is Project 4 unique? Because the payments are the same. If we have the same payments coming in every single year, we call this an annuity. And so there's a different way and a faster way we can go through and compute this one because it's the same payment. So my payment amount of the annuity by definition is the same thing year after year. And instead of using the present value of a dollar, I'm going to use the present value of an ordinary annuity of a dollar. And this is going to be 4 periods at 8%. So again, it's an annuity. It's the same amount. And so what I need to do is to say, well, how many times is that annuity being paid? It's being paid 4 times. My interest rate is still going to be at 8%. 4 periods at 8% is 3.31213. 3.31213. So the present value of the future cash flows is going to be 89,428. And you might be saying, Bennett, well, this isn't equal to the net present value, but we're not done yet. The cost of the investment is 80,000. So right over here, cost of investment is 80,000. So my net present value is going to be 9,428. Is that the exact same as using the table 4 times? And the answer is absolutely yes. However, when we're going through and looking at this, you want to kind of say that it's going to be whatever is going to be easier for you. Definitely if the payments are the same, right? We can only use this if the payments are exactly the same. That's when we go through and use it. So now it's a different way to solve it. Based on our analysis, which project would you recommend, if any? Well, in general, we will recommend the project with the highest net present value, or project 3. Okay. Now, why would I recommend this project? Please quantify our result. Well, the net present value for project 3 of 11,179 is, it's 1,751 higher than project 4, and also 3,865 higher than project 2, and it is 8,392 higher than project 1. So what we could say is that is 8,392 higher than the net present value for project 1, 3,865 higher than the net present value for project 2, and 1,751 higher than the net present value for project 3. Now, as we go through and look at this, what else is kind of going on here? Why does project 3 have such a high net present value? Well, the reason why it has such a high net present value is that if we look at how the cash comes in, generally, the sooner it comes in, the better. Why is that? Well, if we look at these percentages as cash comes out later, this is being discounted by 0.73503 in year 4. This is being discounted at 0.92593 in year 1. So in general, the projects that have a higher amount of cash flow coming out earlier on are going to have a higher net present value. And that is the reason why we would go through and choose the project. Now, what if an amount was negative? Well, we would want to go through and address that. So if you have something that's negative, you would probably want to kind of say something like, well, if we're going to be losing money in year 1 or in a future year, that might not be something that's going to be good for us depending on the overall net present value. So again, that is my created problem number 1 of looking at the net present value of a variety of projects. Hope you found this video to be helpful, and I look forward to seeing you on future videos. Thank you for watching. If you have any questions, please feel free to email me. And thank you for liking and subscribing. Have a great rest of your day.